ಎಲ್ಲರಿಗೂ ನಮಸ್ಕಾರ ಸ್ನೇಹಿತರೆ. ಇನ್ನೂ ಸನ್ ಕಾಮರ್ಸ್ ಕ್ಲಬ್ ಯೂಟ್ಯೂಬ್ ಚಾನಲ್ಗೆ ಸಬ್ಸ್ಕ್ರೈಬ್ ಆಗದೇ ಇದ್ದಲ್ಲಿ ನೀವು ತಕ್ಷಣ ಸನ್ ಕಾಮರ್ಸ್ ಕ್ಲಬ್ ಯೂಟ್ಯೂಬ್ ಚಾನಲ್ಗೆ ಸಬ್ಸ್ಕ್ರೈಬ್ ಆಗಿ, ಅದೇ ರೀತಿ ಬೆಲ್ ಐಕನ್ನ ಪ್ರೆಸ್ ಮಾಡಿ ಆಲ್ ಅನ್ನೋ ನೋಟಿಫಿಕೇಷನ್ನ ಸೆಲೆಕ್ಟ್ ಮಾಡ್ಕೊಳ್ಳಿ ಸ್ನೇಹಿತರೆ.
Dear students, in this video I am going to teach you that how you ought to calculate leverages. As already you know that there are three types of leverages here. One is operating leverage, second one is financial leverage, and third one will be combined leverage. Before calculating leverages, first you have to prepare income statement. Then how to prepare income statement? Let us see the format now. The format of income statement: first sales, so you have to calculate that is number of units sold into selling price per unit, then less a variable cost or expenses on sales, that is variable expenses on sales. Then if you deduct a variable cost from the sales, then you will get a contribution. Then you deduct a fixed cost or fixed operating expenses, then contribution minus fixed operating expenses, you will get EBIT or operating profit. So EBIT means the earnings before interest and taxes. You call it as operating profit. Next, you deduct interest or a financial expenses from the EBIT, then you will get EBT or taxable income. EBT means earnings before tax. Then less income tax, you should calculate a tax on this taxable income. If you deduct income tax from the EBT, then you get earnings after taxes. Then you deduct preference dividend from the earnings after taxes, then you will get earnings available to equity shareholders. And finally, you can calculate EPS here. Then earnings available to equity shareholders divided by number of equity shares. So dear students, so what is the nature of this variable cost and the fixed cost? Whereas variable cost, it is vary with the production or sales. It means is a positive relationship between the sales and this variable cost. When increase in sales leads to increase in a variable cost, or if decrease in sales leads to decrease in a variable cost, it means is a vary with the sales. If sales changes, the variable cost also changes. Then how about this fixed cost? The fixed cost will never change up to this certain level. The fixed cost will remain the same. Okay. Then interest means the payment made to debenture holders or outsider funds, like interest on loans, interest on borrowed funds, interest on debentures. Let us see now. We'll take a simple problem and I will show you that how to prepare a leverages, how to calculate leverages. Before that, let us see the formulas in a one by one. First one, operating leverage. Say operating leverage equals contribution divided by EBIT. It means the operating business, that is from sales to EBIT point. So here sales to EBIT, we're going to consider this of business operations. We're going to see this business operating risk, so that we're going to calculate operating leverage, the fixed cost. How are you going to use a fixed cost effectively? The fixed expense, that is the fixed assets. Then from EBIT to EPS, you'll see this financial leverage point. So there you're going to calculate a financial risk. You can know this financial risk. So financial leverage equals EBIT divided by EBT. Our financial leverage will be called in other name also, that is trading on equity. Now another formula, that is combined leverage. This next leverage will be a combined leverage, whereas here the contribution will be EBT. Then our operating leverage into financial leverage. There are two formulas. We can apply any one of the formulas. Now let us take a simple question, and I will show you that how to prepare income statement and how to calculate leverages. The first problem here: calculate operating and financial leverage from the following information. Sales rupees 1 lakh, and the variable cost is 60% on sales, and the fixed cost is 15,000, and the income tax is 30%. And income tax is 30%. Interest is rupees 5,000. Now let us prepare income statement first, based on the information. So first sales. So sales is 1 lakh. Then deduct a variable cost. That is variable cost of 60% on sales. That is sales here 1 lakh. The 60% on 1 lakh will get 60,000. Therefore 1 lakh minus 60,000, you will get 40,000 as contribution. Then deduct a fixed cost. A fixed cost here 15,000 now. 15,000 from the contribution, that is 40,000. 40,000 minus 15,000 will get 25,000 rupees, and we call it as EBT, or operating profit. Then you deduct, that is EBAT, earnings before interest and tax. First you deduct interest. Therefore less interest now. The interest is how much? 5,000 rupees. So 25,000 minus 5,000 will get 20,000 rupees as EBT, or taxable income. Then if income tax rate is given, then you deduct income tax, otherwise no need. We enough the details up to EBT for calculation of leverages. Anyhow, they have given income tax rate here, that is 30%. You deduct 30% now. Less income tax, that is 30% on 20,000. What is this taxable income? This is 20,000 here. So 30% on 20,000, you get 6,000. So therefore 20,000 minus 6,000, you will get 14,000 as EAT. So this is how you have to prepare income statement. So once you prepared income statement, just you calculate leverages. You'll take the first leverage, that is operating leverage. So operating leverage equals, what is the formula there? The contribution divided by EBIT. So operating leverage formula, contribution divided by EBIT. So let us see this contribution in this income statement. Here contribution is 40,000 and the operating profit is 25,000. So therefore the 40,000 divided by 25,000, you will get 1.6 times. So 1.6 times. So 40,000 divided by 25,000. So what it indicates? 1% changes in sales leads to 1.6% changes in EBIT in percentage. I'm telling you in a percentage. Now let us take next leverage, that is financial leverage. What is the formula? So EBIT divided by EBT. So EBIT means earnings before interest and taxes divided by earnings before tax. So let us see. So what is the EBIT here? The 25,000 rupees. So 25,000 divided by 20,000. So 25,000 divided by 20,000, you will get 1.25 times. 1.25 times. Next, combined leverage. So what is the formula? Operating leverage into financial leverage. So operating leverage, so 1.6 times. And what is the answer for financial leverage? That is 1.25 times. So 1.6 times into 1.25 times, you'll get 2 times, approximately 2 times. This is composite leverage. So there's 2 times. This is overall risk. Why do we calculate combined leverage? To know the overall risk of the business. Why do you calculate financial leverage? To know the financial risk of the business. That is interest burden. Why do you calculate operating leverage? To know the business risk or operating risk. I hope you can get how to, just you can get to know that how to calculate leverages here There are three types of leverages: operating leverage, financial leverage, and combined leverage. Thank you, dear students, for watching the video.